Okay, welcome to part two, AWS trading. And today we're going to discuss the strategy that we'll be implementing. And just to note that the code and the diagrams for the strategy can be found on GitHub. So note in part one, we covered the data pipeline portion of the AWS trading bot architecture. I demonstrated how to set up the AWS environment, including creating a simple DynamoDB database or collection of tables, essentially, to hold our price and strategy data. Then we walked through the data pipeline code in detail. And at the end, I showed you how to get the data and populate the DB with it. In this post, we'll be covering the strategy that we're going to implement. As a quick aside, I did try to make the architecture relatively modular. So if you have a different data API or you want to use a different DB, you can do that. But I just wanted to make something that was relatively accessible for most people who might stumble across this. In this example, we're using the Yahoo Finance API, and again, the DB is DynamoDB. So the strategy. In the end of part one, I needed to choose a strategy, and I wanted to do something a little bit more interesting than a moving average crossover, which is essentially the hello world of algo trading. So I decided on a market neutral, long only ETF strategy. It sounded interesting to me to implement and to kind of do some basic exploration around. It does have some quirks though. Since it's long only and we need it to be market neutral, we initiate the synthetic short positions by purchasing inverse ETFs. So overall, the strategy is a pairs trading strategy. In this strategy, each pair will be equally weighted. And then within each pair, we allocate market neutral weights accounting for the leverage of the inverse ETF. So just keep in mind, most inverse ETFs are in fact leveraged. So if we were using a 3 times leverage ETF and we had a $100 portfolio, we would invest $75 in the unlevered portion. In this example is XLF. And $25 in FAZ. So a 3-to-1 ratio, unlevered to levered. So now we'll explore a little bit of the theory about how we expect it to make money. And I did that a little bit in the exploratory analysis. So we have to consider market direction and volatility specifically. And volatility is especially important because of the leveraged inverse leg. And we'll talk a little bit about why in a second. But in theory, we expect the strategy to perform well in moderate to strongly trending markets. This strategy will get cooked in high volatility range-bound markets. And this is because of something called volatility decay or beta slippage, or there might be some other terms that you might come across. But essentially the idea is that for a sequence of returns, there will be a gap between the underlying's theoretical leveraged return and the actual return from the leveraged inverse ETF. Now, this results from the fact that the inverse ETF has to rebalance daily to maintain the proper leverage. And they do this by literally buying high and selling low, right? So they have to buy in the direction of the increase and they have to sell in the direction of the decrease. So I detail more about this concept in a previous blog post that you can click here to find. And I go through it in detail and examples of what is actually happening under the hood for why this phenomenon occurs and why most people don't understand it. So here's a little bit matrix about how we expect the strategy to perform based on market direction and volatility. And we split the volatility into 3 regimes: low, moderate, and high, or low, medium, and high. This is a little bit more of a detailed exploration of that idea using XLF and FAZ. And we talk about what happens in each leg given the volatility and direction. And you can see sideways again because of the severe decay losses. We do not expect the unlevered, we don't expect the leveraged leg FAZ to outgain the losses in XLF, and XLF is basically going to oscillate around zero, and so the strategy is going to lose a lot. So we're not going to gain anything on the upside, and we're not going to gain anything on the downside, and we're just going to keep losing because of the decay of the FAZ, of the leverage leg. When it's bearish and we have moderate to low, excuse me, and we have moderate to low volatility, it's going to depend very much on the sequence of returns, whether or not it's slightly negative or break even or just negative. And so here we are with the exploratory analysis. Here we can actually look at it here a little bit bigger. So these are just the raw returns of the pair had you invested in it and held. So we can see most of the pairs actually end up positive over time, except for XLE, ERY. Here we are looking at the regimes, the volatility regime relative to the correlation regime, and the correlation is between the two legs, right? So in QQQ, SQQQ, the correlation regime would be how correlated is QQQ with SQQQ, as well as how volatile is the pair. So you can see that we have low volatility, low correlation, low volatility, medium correlation, and so on. And so what I think is interesting is we would expect that high volatility, lowest correlation, in my opinion, you would think that that would have the most diverse or wide range of returns, but it doesn't. And it doesn't for all of them. In this case, for example, high volatility, high correlation has the highest. But when we look at SMH, SOXS, high volatility, low correlation has the highest dispersion of returns. TLT, TBT, high volatility, high correlation again, as well as XLY, ERY. But then XLF, FAZ follows that high volatility, low correlation dispersion again. The next row, we look at the Sharpe ratios relative to the two regimes. Without summarizing these into like a table, I don't see any obvious patterns. Obviously, XLE, ERY has the worst performance during medium volatility across all correlation regimes. XLF, FAZ, low vol, low correlation is really bad, as well as medium volatility and low correlation. SMH, SOXS tends to do well regardless of regime. So that speaks to an overall market trend or economic trend that is not really beholden to these typical regime changes. TLT, TBT, we can see high volatility, low and medium correlation is pretty poor performance, as well as medium volatility, high correlation. So I say that to say this strategy could benefit from individual pair filters based on regime. And then the last exploration is just the annualized Sharpe ratio by year. And so we can see it's pretty diverse. So we would expect a portfolio of them to do pretty decently. And we can see that in a second. So I also ran a custom back test for the strategy. And what surprised me is that the overall strategy with these pairs is decently correlated with SPY. So that kind of surprised me, to be honest with you. But volatility is lower, and Sharpe ratio I think is similar. I don't remember what the SPY Sharp ratio is over this time period. For the portfolio, it was about 0.8, which is pretty decent. Max drawdown, we can see, is almost 20%. And it really underperformed from 2022 into mid 2023. And so we can just kind of look at the returns, rolling Sharp ratio, trading costs based on when it happened. So in this back test, we use slippage as well as commissions, but that can be modified. And again, the code is in the GitHub. I don't know why this is so hard to see. The opacity might not be dark enough. And then we have our cost, cumulative cost, and the amount of cost drag in the portfolio. So this is basically the difference between the gross returns or the gross equity curve and the net equity curve. And it's a function of our trading activity. The correlation between the strategy and SPY was roughly between 0.6 and 0.7. Some things to improve if you want to take the strategy and work on it yourself, or for me, this is what I would probably look into further researching. The portfolio weighting scheme is extremely basic, right? We're using equal weights, but it may improve by incorporating volatility and momentum into the weighting scheme. As we saw with the exploratory analysis, that the performance of the pairs varies based on volatility as well as correlation. So there might be a good use of volatility regime filters, on the portfolio as a whole, and each pair individually could benefit as well. One thing to note is that the strategy is very sensitive to the rebalance frequency. So what I noticed was the more frequent the rebalance, the worse the performance. And the way I set up the back test was that the individual pair would be rebalanced if the portfolio weight of the pair deviated beyond some threshold. So I don't want to go too much deeper than we already did. Again, this is just a toy strategy to implement to keep it interesting. And we're going to go through this in more detail, how to actually implement this using AWS Lambda in the next YouTube video and the next blog post. So if you want to join the conversation, join the Discord. If you want to reach out to me directly through email, you can do that as well. But other than that, thank you for your time. And if you have any other questions, feel free to reach out or drop a comment.